So the focus of today's lecture is on private equity. Just before you did the cut, we had a lecture on mergers and acquisitions. And before that lecture, the preceding lecture was on financial distress. And we said one of the ways in which a company can come out of financial distress is through mergers and acquisitions. But then when we dealt with the lecture on mergers and acquisitions, why companies go into mergers and acquisitions, and the different types of mergers, including the proxy contest, I also mentioned leverage buyout and management buyout. But I said we will not dwell into that because that belongs to the private equity lecture, which is our focus today. So when we talk of private equity, what exactly is it? What exactly is it? It is simply the injection of private capital into a private business or even a public entity on the whole firm or part of it. All part of it. We said in the financial distress topic, companies will be struggling because they don't have adequate capital. So when we have that private capital injected in the firm so that it is back on its feet, that is what we refer to as private equity. Another thing that you need to note is that this equity or capital is not freely tradable in capital market. Think of it this way. A company is struggling because it cannot raise capital even from the banks, for instance, because of very high cost of capital. It's what we covered in the capital structure lecture. So for that reason, this capital that is injected into the firm is not freely tradable in the stock market because it has not been raised through what we call the IPO. And why would you be interested in injecting private equity or private capital in a firm? You do this, you assess that company, you realize that the only reason why this company is not doing well is because of lack of capital. So it has the market scope, the products can sell, and therefore you do this with the hope that the value of the company will go up and you realize higher returns. And I'm also saying that, like any other emerging market, Kenya is not an exception. There has been increasing interest in private equity, particularly with respect to mergers and acquisitions, which we dealt with in the last lecture. So there are broadly 4 types or different forms of this investment. Broadly 4. Leverage buyout. This is something that is in your notes in the last lecture on mergers and acquisitions, but which we did not go into it. So leverage buyout, from the word leverage, financial leverage, the level at which a company is operating on debt. That's what you are taught in your CFI 1, financial leverage. So leverage buyout here then refers to the purchase of the entire company or part of it using a combination of equity and debt It doesn't have to be both. In most cases, it will just be the injection of equity. But I want you to note that it can be both. And the reason why I'm saying I want you to note that it can be both is when we'll be looking at the real life examples concerning the Kenyan scenario where Safaricom received both equity and debt from IFC. IFC is a private investment arm of the World Bank. The other thing I want us to note with leverage buyout is that the target is on mature companies with good cash flows. That's the target. That's the target. If you inject too much capital relative to the existing, then you have a controlling stake in that company. You have a controlling stake. Growth capital, minority injection of capital into a company. In this case, you have a company that requires funds, money. It is in a growth stage. It needs, say, capital for expansion. It needs maybe money to acquire another company. A good case in point is when we were discussing mergers and acquisitions, and we said that KCB acquired National Bank at how much? How much? It was 14 billion. I'm not asking as the price per share. It was actually 1 shilling. That is the price per share. But the overall amount was 14 billion. Suppose KCB did not have this money and wants to acquire National Bank. Then this is where private equity comes in. But then, here, you have minority equity investment, so that you don't have a control. You don't have a control in the company. Like in most cases of leverage buyout. So what you'll be targeting is just a return on the money that you have put in that investment. The mezzanine capital, we'll be looking at the world's largest private equity firm, including the BlackRock, the Blackstone, the KKK, and you'll find that some of them just invest in mezzanine capital, where the interest is only on the subordinated debt. Remember, in the topic of financial distress, we said that a company can come out of financial distress through a private workout. But then we also said there can be the straight liquidation. If there is straight liquidation, what does the trustee or the receiver manager do? Sell the assets. How do you distribute the proceeds from the sale of assets? We talked of absolute priority rule, which is APR. In that case, we mentioned the subordinated debt, which comes last. No, I want you to distinguish between superior debt and subordinated debt. And we said superior debt is which is collateralized. So here a company will invest in money, inject capital in a company, and this will not be collateralized, and therefore it is just like giving debt to any other firm. You just get a return on your investment, and which is similar in most cases to the preferred stock, which comes with a specific or a fixed rate of return. There are warrants of conversion whereby if the company feels is not doing very well and is not able to give you the returns on the money you are putting on the mezzanine capital, then you are asked, can you convert this debt into ordinary shareholder or ordinary equity? That's what we are talking of, the rights to conversion to common stock. Venture capital. This one finances early stage companies. And before we finish the lecture, we'll be able to compare venture capital with private equity. Ideally, it is part of the private equity, and see where the difference is. It is just seed capital for companies that are coming up and cannot access bank loans. You walk to a bank and you tell them you have this very innovative idea, assuming you are the one who is coming up with the invention or the innovation on M-Pesa. So you walk into the bank and tell the bank manager, I have this innovation, fintech, financial technology, digital finance, which will revolutionize the way we do transactions. It will be mobile money. You give the story to the bank manager and he says, okay, hang on. Tell us how you'll make money out of that. You are just young, you have just graduated from the university. You have the idea. You don't have any collateral. So the bank manager looks at you and says, we have never heard of that. So we can't finance you. That's why venture capital exists. And they strictly deal with technology, biotech, and what we call the clean energy financing. You know, you have an idea, you don't have money. That's what we call seed capital. And that's how some companies that you see big today, like Facebook, like Twitter, that's how they started. And the funding came from the venture capital, where the banks will shun off from financing. So although private equity will include all the four, in most cases when we talk of private equity, what you'll see in reality will be leverage buyouts. Most of the cases that's what you see. Leverage buyout. And those firms that engage in these are called financial sponsors. Why are they called financial sponsors? Because you just bring money and no synergies. We look at the present value of a merger when we are dealing with the mergers and acquisitions. And we said one of the advantages is the synergies that you get when one firm merges with another, particularly when they're in the same sector. The vertical integration or the horizontal integration. You give synergies. KCB and National Bank were in the same sector. And they were previous competitors. So the synergies could be in the form of management that KCB has in managing banks that NBK will benefit from. Just like I've said, there are no synergies. There are no synergies. It's not a case of strategic buyers. You know, KCB was a strategic buyer on National Bank. Same case with Access Bank, which I told you is the largest commercial bank in Nigeria. It is a strategic buyer on National Bank. See? And I told you that they have acquired Cedian Bank last year. So these strategic buyers bring synergies, but not with the private equity. Private equity is you inject your money and you leave the management to go on managing the firm as it was previously. The other thing that you need to note at this point is that private equity consists largely of institutional investors. Largely of institutional investors who are ready to put their money not for the short run, as we call it in economics. See, And they hope that the money can turn around the distressed firm or company, and then they realize the returns out of that. For example, assume that there is a private equity, institutional investor, or even those we call high net worth individuals who are interested in KQ, Kenya Airways. Of course, you know it is the best example we can give of a financially distressed firm, just like the Mumia Sugar. You come in as an institutional investor, you'll be patient enough to put your money for 5 or so years and turn around the company. Now compare these two, the private equity and the public equity. So what's the difference? No, you already know what is public equity. When companies go to the stock market, in the primary market to raise money, to raise finance, I said they do it 2 ways. It can be through the IPO, initial public offer, or it can be through private placement. And I said that route of private placement, you avoid the capital market authority. And therefore you approach institutions, you know they have idle cash, like the pension fund, NSSF, insurance companies. You know. That is what we call, when you raise money from the stock market, that is public equity. And we know for sure that in the public equity, it is liquid. It is liquid because you can buy shares from any company listed at NSE and sell them and sell your shares tomorrow. That's a definition of liquidity. The ease at which you can convert your asset, financial asset, into money. Ownership is dispersed. Ownership is dispersed. You find so many shareholders from different regions, from different sectors of the economy, buying the shares. The opposite of dispersed is concentrated. So the ownership is dispersed because you look at the shares outstanding from Safaricom. It is close to 1 million. And I told you that is what makes the earnings per share of Safaricom low. Because even if Safaricom makes so many billions net profit, the determinant on what you get at the end of the day as your dividends is a denominator, which is the number of shareholders, all shares outstanding. You divide with that. So even if Safaricom is the first company in East and Central Africa now to become $1 billion company, I don't know whether you saw that. They reported 140 billion. Because of the number of shares outstanding, ownership which is dispersed, the earnings per share will not be that high. Valuation is relatively easy because in the stock valuation topic, you look at the value of the capital gain, which is the difference between the amount of money you spent buying the share and the value today. And also you do the valuation of the dividend using the dividend growth model, and then you combine the two. Intermediaries are large. The financial intermediaries involved in the stocks. We call them investment banks. Others are stock brokerage firms. So finance is divorced from control. Is divorced. You put your money, you buy shares. You buy shares from, say, Kengen. in the company. Then you walk home. You are not involved in the running of that organization. So, on the contrary, what you find with the private equity are two forms. We have discussed 4, but in most cases you find 2, which is the leverage buyout and the venture capital. And the characteristics of what we have discussed with what happens in the stock market is just the opposite. So, you don't inject equity and then get it tomorrow. It is liquid. Ownership is concentrated because few people own the company. Valuation is difficult. Intermediaries are small. Finance is diffused. Finance is accompanied with control. When you inject money into a company that is struggling and you exceed the 50% mark, you don't necessarily have to exceed. Because if there are several players and you have higher shareholding, even 15% could be the majority, so that you have a controlling stake. You have a controlling stake in it. So that becomes the difference between the private equity and public equity. Public equity which freely trades in the capital market.